Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to the latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. This is one of our special episodes at the U.S. Private Credit Direct Lending Conference in Nashville, hosted by LSTA and Deal Catalyst. Joining me for this episode is Dina Kook, Head of Fund Finance at Monroe. Dina, thank you.
Thank you for having me. I'm happy to be here.
So if you'd have to describe, what does the fund finance market look like today? Borrower-friendly, lender-friendly, and which side of the fence do you sit on?
Yeah, absolutely. So I'm on the borrower side. And we certainly had been in a borrower-friendly market for the last 2 years or so, certainly since the chaos that was 2023, right? That was a hard year to be a fund finance borrower. But over the last 2 years, honestly, my phone has been ringing off the hook. Lenders calling me up saying, hey, we're open for business. I've got capital to deploy. Hold sizes are going up. Structures are coming in. Pricing was dropping rapidly to levels I hadn't seen in years. And I think a lot of that was just being driven by increased competition in the market, right? So we had a slower fundraising environment. That's going to lead to fewer fund finance opportunities. You have banks that have budgets to make, and you have new entrants into the market, new products. That's just naturally going to increase competition, which is going to shift things towards the borrower's favor. That is starting to change now, though, for certain segments of the fund finance market. So here's where I'm going to bifurcate between the two primary products that I'm utilizing. One is sublines. And there, I think that market has stabilized. I do think we've hit the floor on pricing, unfortunately, but I don't see it going back up either. So there, I would say the market is neutral to maybe still more borrower friendly because of all the competition there. ABLs, on the other hand, which is really the bulk of the financing that I'm utilizing. So those are asset-backed facilities to drop down SPVs that are collateralized by our underlying portfolio investments, which are private credit. Those naturally are kind of shifting back towards the lender's favor, just given all the noise in the private credit space right now. And in terms of meaningful changes, pricing, structure, the current quote-unquote crisis in private credit, I mean, has that shifted the dynamic, or is the broader change happened over like the last couple of years? I do think crisis is a bit of a strong word, but certainly there's been a lot of noise. There's been some headwinds in private credit, and understandably our ABL lenders are reacting to that. So we know pricing is going up on those. I'm hearing still a pretty wide range on where my ABL lenders think the pricing should be and how they're thinking about pricing that risk. So I think there's still a good amount of price discovery, market discovery going on there. It is still very early days. I think they're maybe going to be tightening down a bit on recurring revenue loans and software and things like that. I mean, what I'm hearing from my ABL lenders pretty consistently is they are all getting questions from top of the house, right? Senior management or their risk officer who are seeing headlines or forwarding them articles from the Financial Times and saying, what is happening here? Like, I need you to defend your business. And so they've been spending a lot of time doing that. that. They've been filtering those questions down to us. A lot of those are around software and redemptions, and so we've been working through that with our lenders. And I think as a result, there's a lot of hesitancy from the ABL lenders to entertain opportunities that are hairier or more complex. They're really looking for clean, plain vanilla facilities right now with existing relationships that they know and they trust.
And do you guys have some of the you have closed-end funds, interval funds? Like, do you have a mix?
We do.
Where some of those questions would obviously make sense for you?
We absolutely do. Yeah, we have a mix. We have closed-end funds, commingled funds. We have SMAs, and we also have BDCs.
Got it.
And that's where those questions on redemptions are really coming into play.
Yeah. So when you think of if you broaden it out and you think of fund finance, you used to be at ING.
Yep.
Obviously a large bank, lender side. The biggest difference from, say, 5, 6, 7 years ago, is it just scale?
Yeah.
I know there's more products today.
For sure.
What else is different in terms of the broader fund finance market?
Scale is the most noticeable thing. Like, I've been going to conferences like this and the fund finance conferences for years, and that's just such a good visual representation of how much that market has grown. We've got new entrants, we've got new products. I think we have a different definition of what fund finance means. You've even seen a lot of fund finance professionals bouncing around different firms and starting up new businesses. And I've been in fund finance my entire career. I feel like a bit of a lifer at this point, and it's been really cool to see that growth and that evolution over the years.
Yeah. So, you joined obviously a few years ago. How does your past experience shape your approach, especially that you've gone from lender to borrower? So you kind of have an insight into what the lenders are thinking.
That's absolutely right. I have to say it was actually a pretty seamless transition going from lender to borrower. I kind of took off my lender hat, I put on my borrower hat, and yes, it required a shift in mindset and mentality that took some getting used to, but it was actually pretty seamless. And I think having had the lender perspective and coming from a large bank, I sort of have a good appreciation for what the lender's pain points are and what their pressure points are and what some of their internal challenges might be. And so when it comes to negotiations, I have a good sense of where I can push them a bit more and where I should sort of back off because it's not going anywhere. And I think the lenders have a good appreciation for that, and I think it really helps in negotiations becoming more efficient. The other thing I would say, coming from the lending side, and I was there for many years, I worked with all types of different borrowers. Not all borrowers are created equal in terms of the borrowers you want to work with. And so I got a good appreciation for, what are best practices of being a borrower? And those are things that I now try to emulate as a borrower for the benefit of my lenders. And that really comes down to over communication. We are oversharers, being extremely proactive. If we even think there is a problem, we will pick up the phone and we will call them. And I think that's something the lenders also really appreciate.
What would you say differentiates Monroe as a borrower in today's fund finance market?
Yeah, I think what differentiates us as a borrower in the fund finance market is the same thing that differentiates us in the broader private credit space, right? So we are lower middle market focused. We have a 20+ year track record, and we have stuck to our knitting. And there's not a lot of folks in the space that can say that. And so for a lot of our lenders that may have a lot of core or upper middle market focus, we bring diversification into their underlying collateral. I would also say that we are really focused on being a trusted partner and in doing what we say we're going to do. And that's both on the borrower and the lender side. And that's something that our lenders really appreciate. And then we're also very, very relationship focused. I am not really looking to do a one and done facility unless that lender has an extremely bespoke product that no one else can do, but that's very, very rare. I'm looking for repeat business, and that's what the lenders are looking for as well, right? Like they're looking for borrowers that they can continue to grow with and that that they know.
So when it comes to borrowing, what are some of the core objectives you're trying to achieve? Liquidity, IRR enhancement, portfolio construction, something else entirely?
Yeah, it depends on the fund strategy, right? For our levered funds, this is going to sound obvious, but the goal of using leverage is, to achieve an enhanced levered return. And we do that by utilizing permanent leverage. That is generally, not always, but generally in the 1-to-1 range for our flagship funds. So very modest use of leverage, and we do that through using ABLs, CLOs and securitizations, BDC corporate revolvers, unsecured debt. There are a number of products that we can use for that. But for all of our funds, whether levered or unlevered, we're using sublines as well. And that's really for the traditional purpose of bridging capital calls and liquidity management. So being in private credit, we are funding new deals all of the time.
Yeah.
It would be highly impractical for us to have to call capital every time we're closing a deal and then wait 10 to 15 business days for that capital to come in. The realistic,
probably would annoy the LP as well.
And it would absolutely annoy them. And the realistic alternative to that would be to park a bunch of cash on our balance sheet, which is inefficient and creates a cash drag. So that's really what we're using the subline for, is for treasury and liquidity management and working capital.
Would a similar answer be the type of product you're looking to use? So sublines or NAVs, hybrid structured solutions, really would depend on the fund?
It does. It depends on a lot of factors. It depends on where the fund is in its life cycle. It depends on the fund structure. Is it a drawdown fund or is it a perpetual life vehicle? It depends on market dynamics, the fund's leverage strategy, the investment strategy. It depends on a whole number of factors. And for every fund, we will look at all of those and we will tailor a leverage solution specific to that fund. Generally, the way we operate is we'll put the subline in place day one. If it's a levered fund, we're actually often using hybrids. And we'll use the subline or the hybrid to fund the first few investments. Once that portfolio has achieved sufficient scale and diversification, that's when we'll look to start layering in our asset-backed facilities like our ABLs. We use rated products as well, rated note feeders and CFOs. Those we actually consider to be more of a fundraising tool. It's interesting that they have fallen under the definition of fund finance.
It's kind of evolved to that, right?
It has evolved, and that's what I was saying about the definition of fund finance having changed, right? And I understand why they're falling under that umbrella. It makes sense, but to us, the purpose of those, we really view to be more a fundraising tool.
So if we think about the private credit platform from Monroe's point of view, you wouldn't be using, say, your typical NAV, which has really been defined as like a PE fund use of NAV.
Yeah.
Why and
what
is a private credit versus maybe private equity platform? What's the difference there?
For sure. It would be really unusual for us to do a NAV line because the bulk of our portfolio investments are direct lending assets. Those fit really nicely into an ABL or into a CLO or securitization, and we can get much more efficient leverage using those types of structures versus like a PE NAV line. The one exception to that would be when we're trying to finance, assets that don't fit neatly into that box, right? So ABF is a great example of that. So for an ABF strategy, that's where we would look to utilize a NAV line.
LPs, obviously, they've gotten very used to sublines.
Yes.
But when it comes to some of the other fund finance products, how has been the evolution of the LP dynamic, and are they starting to get maybe a bit more schooled in some of these other products?
Yeah, it's interesting actually. We have seen increased demand from our investors for our levered strategies. That was always the case for our retail investors. They tend to favor levered strategies, but now we're starting to see it on the institutional side as well. So for our most recent flagship fund that we raised, the ratio of levered dollars to unlevered dollars was higher than for our predecessor funds. And I think it is because our LPs are just getting more comfortable with our use of leverage, which is quite modest at around 1-to-1. They're getting very comfortable with the products that we're using and the lenders that we're working with.
And in terms of transparency around is it more? Are you trying to be more transparent with LPs today? Are they asking more questions about fund finance today?
Yes. So we have always aimed to be very transparent with our LPs, but we have definitely noticed an uptick in questions recently, both around our underlying portfolio investments, but also on our credit facilities. So they're doing a deeper dive into our terms, our structures, which lenders we're working with. Our LPs are reading the same headlines that we are, right? And so, when they see an article about certain lenders marking down, private credit portfolios, we got a lot of questions around whether we were exposed to that type of risk as well. And so that's really what we've been seeing, is just kind of a deeper dive in terms of their questions.
So speaking of LPs, insurance companies obviously have found a home in fund finance. Are you seeing other types of investors, pensions, family offices begin to kind of utilize this space and become more interested in this space, more questions around it?
Yeah, I mean, where we've mostly seen insurance investors participating are in our rated products, so our rated note feeders and our CFOs. That's obvious, right? Those products were structured for the insurance investor and for their specific needs. Other types of institutional investors, pension funds, family offices, they have an easier time investing directly into our funds as LPs. That said, we have seen some of them coming into our rated products, just maybe a bit further down the capital stack because they're more yield driven. So we could continue to see more of that. I do think the bulk of those products will be comprised of insurance investors.
You guys issued a CFO.
Yes.
How many have you done? And I know you said before, very much a fundraising tool, that and rated feeders. Maybe tell us a little bit more about the broader thinking around that strategy.
Yeah, absolutely. We've done one CFO so far. We were very happy to get that done. That was a great transaction. We would absolutely look to do those again opportunistically when it makes sense. Rated note feeders, again, we're already using those. We will continue to utilize those for our insurance investors. Great way to get insurance investors in. So yeah, again, those are a great fundraising tool for us, and we'd absolutely look to continue utilizing those where it makes sense.
You know, one thing we've obviously heard about here, have seen it across the events that we put on, is there's a greater convergence. Structured markets into non-structured markets. Fund finance is now connected to secondaries, to private credit, to everything else.
Yes.
What are some of the reasons behind the convergence? And obviously, I think you're seeing the same thing at Monroe.
We are absolutely seeing the same thing. I think that's sort of just the natural progression of the space. It's getting increasingly confusing, right? Like, who's a borrower, who's a lender, competitors financing each other. I get it all the time. People often think I'm on the lending side, right? So we're definitely seeing a lot more of that convergence. I think all of those products you mentioned are ultimately trying to provide more liquidity into the space, right? It's just a matter of how that's done. Maybe one just micro example of the convergence that I'm seeing just at Monroe is the way that we are set up is we have my team, the fund finance team, that handles all of our non-rated and non-structured products. And then we have our structured solutions team, which handles all of our rated and structured products. And historically, our teams operated very, very separately. So the structured solutions team was really focused more on our CLO business, which we ran as kind of a separate business line. But increasingly, there is so much gray area between our teams now. We work very, very, very closely together. And that's only gonna continue. So just a micro example of how it's impacting my day to day, but I think it's representative of what's happening in the broader market as well.
What innovations are kind of most exciting for you? Hybrid solutions, portfolio leverage, something else?
Yeah, I think it's less about any one innovation. I think all of the innovations that we're seeing have their place in the market and are serving a very particular need. So it's hard to just choose one. I think the fact that this innovation is happening, though, is really exciting and a really good sign for the space overall. It's going to force us to become more agile, more nimble. It's going to make the market more competitive, and I think it's just a really good sign for the fund finance market going forward. I'm excited to see what the next frontier is.
Speaking of the next frontier, are there any particular structural changes you think are going to come in the next decade? Like, are banks going to pull back? Because obviously non-banks have flooded into the space. Will it become an asset manager-led, insurance-led industry versus bank-led, which has been the traditional way?
I mean, I wish I could predict like the next month, let alone the next decade, but I'll give this a go. I mean, look, I think the non-banks are here to stay, but I don't really see them replacing the banks or taking market share away from the banks when it comes to traditional fund finance products. I see the non-banks introducing sort of a new suite of fund finance products and really just expanding what fund finance means. So if I'm just working on a plain vanilla subline or an ABL, I'm probably going to go to the banks, right? That's easier execution. It's going to be a cheaper cost of capital. But I'm talking to the non-banks when I have something more bespoke that I know is outside of the comfort zones of the banks. And so in that sense, I think the non-banks are really going to drive the direction of the market going forward.
Is there as an aside, is there a concern that the non-bank, who might look like Monroe, could potentially be a lender to Monroe?
Yes.
And so it's like,
absolutely
I'm looking
right.
at myself in the mirror here. Should we really take money from them?
Absolutely. It's a bigger discussion. When we are talking to a non-bank that has, an affiliate or a business line that's a direct competitor of Monroe, that's a much bigger discussion internally within the firm, and we will make sure that we really understand how they are set up internally to really understand the information flow and the walls that they've put up.
Yeah, I feel like that's the trickiest
100%.
thing about the market right now.
100%.
One last question before we get to some of the fun ones. What's the biggest misconception about fund finance today?
Yeah. I don't know if it's a misconception, but maybe just a reminder for everyone that at the end of the day, this is still very much a people business and a relationship-driven business. And I think that's going to be especially important as the market continues to expand and mature and to get more commoditized, right? And AI is taking over our lives, right? AI cannot maintain relationships, right? And you can over-engineer a structure as much as you want. But if the mutual trust isn't there, the deal's not going to work, or it's not going to work well, right? And so we just encourage everyone to remember that. And then especially in times like this, right, when the lenders are getting a bit more nervous, it's all the more important that you have those strong relationships established.
So some fun questions as we get to wrapping up here. Favorite sports team and or hobby?
Okay, so I'm not much of a sports fan, nor am I particularly athletic, but I do enjoy skiing.
Okay.
I'm not an amazing, I know, how shocking, right? Someone in finance that likes skiing. So I try to get out as much as I can. I also have a 5-year-old son that I'm trying to get on skis as much as possible. So that's been very fun, but also very terrifying.
It also takes up your hobby.
Yes, it does. Yes, it does.
One surprising thing about yourself?
Okay. So when I was in college, I was in an a cappella group called the University of Pennsylvania Shabbaton. So shout out to them. That's not the surprising part, by the way. That's actually very on brand for me. But when I was in the group, I sang a cover of the song Breathless by the Coors, which I'm not going to sing right now, so don't ask. But when it came time to put the album together, we listed the wrong track name on the track list. So we put Leave Me Breathless instead of Breathless. And as a result, all of the other Shabbaton songs have maybe 5,000 likes or 10,000 listens, right? And that's all our parents, by the way. But Leave Me Breathless, because we put the wrong song name, has 500,000 listens.
Wow.
So, but only because it's the wrong song. So all of you should feel free to check that out when you're done listening to the podcast.
One book you'd recommend reading?
So a few years ago, we actually have a Monroe Women's Book Club.
Okay.
And a few years ago, we read The Women by Kristen Hanna. It's historical fiction. It's about Army nurses during the Vietnam War. This is not a book I would have picked up on my own, but I'm really, really glad I did. It's part girl power, but also just fascinating from a historical fiction perspective, and just really, really moving. And it's a book that's really stuck with me. So I would recommend it for men and women alike.
Most exciting part of your job?
It's definitely the relationship building aspect. So I've talked a lot about how important that is externally, but I didn't realize as a lender how important it is internally as well. And I didn't realize that the fund finance function touches every single other department within Monroe. Right, so we are talking to our portfolio managers about leverage strategy. We're talking to the deal teams about, leverage eligibility. We're talking to our treasury and our allocations team around cash planning. We're talking to IR, BD, legal compliance. We're talking to everyone, and that's been really, really rewarding to get to build those relationships throughout the firm. But also very cool to get that kind of helicopter perspective, right, and sort of see how the sausage gets made. I had no appreciation for that on the lender side.
And then final question, one prediction for the next 12 months.
Yeah, this is a tough one. I think look, it could be bumpy for the next few months. I don't know how long, but I do feel pretty strongly that this bump in the road for private credit is temporary, and that private credit will weather the storm. And I feel even more strongly that the banks that are financing private credit will certainly weather the storm, right? I mean, putting my lender hat back on, we had to make this argument to credit all the time and explain, the strength of the structure, right? The diversification benefits, the fact that it kicks out underperforming assets as credit quality deteriorates, the modest advance rates, and on a look-through basis to our underlying LTVs even lower, right? Not to mention that these structures have withstood previous market cycles, and so I understand why the lenders are nervous. I do, and I've been there, but I do ultimately think we're all going to get through this just fine.
I think that's a good place to end it, Dina. Thank you very much. Appreciate your time. Good to see you.
Absolutely. Thanks for having me.
Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.